Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, May the 13th, 2026. Okay, let's look at a few numbers. We obviously we're waking up to a relatively sort of positive start to the day. We have the equities up. We see the ES up about 18 basis points. You see NASDAQ up about 70 basis points or so. So we can see here that the ES futures are again almost at their highs despite a wobble yesterday. And essentially what the market is trying to figure out, there's kind of two different narratives. The positive narrative is that, AI spending and capex is boosting a lot of sort of industries and materials and industrial metals, and that's going to lead to a lot of sort of productivity gains. And generally, that's going to be sort of a positive story. On the other hand, we do have some negativity, which is essentially saying that because of the situation in Iran with the energy prices spiking, that inflation is becoming more persistent. Inflation is going up, and eventually that is going to sort of cause a problem in terms of the real buying power of American consumers, and that will lead to sort of a slowdown in consumption, which is going to put at some point pressure on the equities. And yesterday we actually got quite a lot of data, and one of the data points is that real wages are actually going down for the first time in a few years. So in the past, over the last few years, when we've had high inflation, let's say 2021, 2022, we had inflation going up, but wages were sort of keeping up, and therefore real wages were actually sort of rising, albeit sort of slowly. But what we're starting to see, and we saw some data yesterday, is that inflation is now outstripping rises in wages, and so real wages are actually going down, which means spending power is going down. And could it be that this sort of sort of energy spike in inflation, a sticky inflation, is actually going to start causing a slowdown at some point? But as I say, there is a competing narrative saying, hey, this whole situation in Iran is transitory, it will be resolved, it's a bit sort of problematic, it's a little bit complex, but ultimately in the next few weeks or months, it's going to be resolved. And we'll concentrate then on the sort of more positive side of things. So before we just sort of look at a couple of charts, let's just have a quick look at that inflation data. And it's clear what we're seeing here. You see here the headline CPI is this green line here, and you can see that it's almost up to 4%. So clearly that stopped sort of stabilizing, is pushing up. But again, we can see that the core services is a big problem there, core goods. But the big one here is energy, of course, is the black one. So you see one of the contributors was energy. And so, it depends if the glass is half full and half empty. This is the headline CPI. And one could argue that, once the situation in Iran stabilizes, over, as I said, over the next few weeks or, 1 or 2 months, then this sort of energy component will come down and we'll get back to a happier situation. But for sure, at the moment, that is a bit of a problem. If we look at some of the underlying elements here, you can see that if we look at the CPI with the energy, you can see just what a sort of contributor that is. Whereas if we take away the energy, you can see that the situation looks a lot more benign. Not perfect, but certainly not sort of in the upper threes and more sort of in the upper twos, which is probably acceptable for Kevin Walsh, who's coming into the Fed. Look, but on the other hand, you could say, well, okay, if it's just the headline and energy and food, maybe the whole problem is that the core is not such a problem, or the whole issue is that the core is not such a problem. But if we look at different sort of measures here, so we've got the super core, median CPI, or the trimmed mean, and keep in mind that the trimmed mean is the one which Kevin Walsh quite likes to look at. And the trim mean essentially says that you take off on both ends the most extreme levels and then take an average of what's sort of in the middle. And also the sticky price are those sort of prices which are difficult to go up and go down, which is sort of a longer lasting. As the Atlanta Fed releases that data here. But so the point is that if you look at different sort of CPI measurements, you can also see that they're all starting to sort of turn a little bit upwards. It's maybe not sort of, like a sort of a massive problem like we had in 2021, 2022. But for sure, the trend is not going in the right direction, even with the sort of more core measures, the trim mean measures. Now, the problem here, which is a political problem for Trump, but also potentially for a slowdown in the consumer, is that, again, looking at the headline CPI, and again, I have to put the caveat that, is it just food? Is it just energy? But the reality is that for everyday people, myself included, we do look at food, we do look at energy. And even though the central banks like to look through the headline numbers and say, hey, we just concentrate on the core, the reality is for the consumer and therefore consumption, that the headline is important. And clearly the headline is going up. But really what's the problem here we saw the average hourly earnings in last Friday's non-farm payrolls actually was lower than expected at 0.2 month over month, and also the Atlanta Fed's wage tracker, which are these two sort of gray lines here. You can see that they're starting to go down. And what we saw yesterday in some of the data is that real wages are actually going down, which in simple English means that inflation is outstripping the pace of wage gains, which means people, in terms of their real spending power, have less. And of course, if that goes on forever and ever, or at least for sort of several months, people will start sort of spending less, and that, of course, could lead to a slowdown in the economy and consumption. Now, in terms of just that real impact on people, just looking at a couple of the subcomponents here. You can see the month-over-month food here, pretty nasty. I mean, the red is just the thing, but there's just the color. But you can see here the trend is definitely sort of starting to push up a little bit for food costs. And just as a typical example here, you can see ground beef, which is like a typical, sort of basic food stuff for a lot of people. You can just see how this continues to rise, and just comparing it to, let's say, 3 or 4 years ago, it's basically doubled from 6 or 7 years ago. So the point I'm trying to make here is that this whole concept of the K-shaped economy, for sure, those with sort of assets, hard assets, are doing well, but those who are just on a wage, this is just a typical example of the pressures which they are under. Again, gasoline, we all know that gasoline is sort of ripped higher. And again, just looking at it in April, 5.4% higher, and just over the last sort of period. So all of this stuff is potentially going to lead to a slowdown in consumption. And again, it's going to depend on the resolution, speedy or otherwise, of the Iran situation. And finally, just want to look at airfares, which again is probably not part of the lower income sort of cohorts, but that also is sort of trending upwards. Now, again, is that just due to fuel prices going up and refined products such as jet fuel? For sure. But the situation here is that the trend, at least in the short term, is for a little bit of pain to the consumer. Now, in terms of what happened yesterday, no surprise here. And just for a bit of perspective, I always like to look at the pre-war. So this is the pre-war situation for where the Fed policy rate could be. And we're seeing here on the 27th of February, which was just, I think it's the Thursday or the Friday before the first Iran attacks. You can see that the market at that point was pricing in over sort of 2 cuts by the end of this year, December 2026. But what we're now doing, we've obviously got rid of all of those, not pricing in any cuts at all. And if we just look here at the 11th of May, we were pricing in just a few basis points of actual hikes by the end of this year. And you can see now that on the 12th of May, which is yesterday after the CPI, you can see that that's pushed up just a little bit. So the point is here is that it's going to be very difficult for Kevin Walsh coming in to justify any sort of cuts at this point. And the market is slowly starting to pressure him, or starting to put the pressure on and push up the yields. So if we start looking at some of the yields, which I want to look at, let's just get into the yields. So I want to look at, let's say, the 2-year. You can see here yesterday, the green counter. So this is not the price, this is the yield. So the 2-year, which is very sensitive to policy and inflation, obviously pushing higher. And if we put that, we're also seeing that on the, let's say, the 10-year, getting up towards the 4.5% level, which is key. And the symbolic sort of 30-year is now over the 5%. So we've got a 10-year pushing up towards 4.5. We've got a 30-year over 5%. If we actually put it on a weekly chart, kind of interesting to see just historically where we're at with this. And I just want to, you see here that the on the 30-year here, can it go higher? For sure, it can go a bit higher, maybe up to 5.2 is where we were last at in October of 23, right in the middle of all that inflation stuff. But if we look at the what's interesting on the 2-year is that we're now getting to levels where we're starting to push above the 4%, which is getting a little bit nasty. And you can see here that on this very long-term downward trend line, we're starting to push above that. So if that breaks higher, I'm not saying it's going to break higher massively and immediately, and the short-term one here is 4.02%, but definitely there's more room to go up here if we continue to see a real economy which is going, relatively well, and if we continue to see a non-resolution in the Iranian situation. And just on the Iranian situation, yesterday, the Iranian authorities released 5 points, and they basically said that they will not go back to the negotiating table unless those 5 points are agreed to by the US. And to be honest, looking at the 5 points, this talks about reparations. It talks about Iran being able to continue with its enrichment of uranium. It also talks about Iran having some kind of sort of sovereign control of the Strait of Hormuz. And in my humble opinion, all of those points are sort of non-starters for the Americans, and let's say the Israelis as well. And so I can't see any sort of negotiations really happening anytime soon. And therefore, we have to assume that oil will stay, maybe not at sort of massively elevated prices, but certainly it's not coming down anytime soon. So the point being here is that for yields to come down, we're going to have to see some kind of resolution in the situation there, or maybe some kind of demand destruction, and even signs that the U.S. real economy is starting to suffer as consumers, as I mentioned earlier, starting to under a bit of to show a bit of pressure. So talking about oil, let's have a look up and see what happened over the last 24 hours and where we're at. Just from a technical perspective here, oil broke out yesterday just on the fact that there's obviously no quick resolution in the situation. And the fact that Trump is now, his focus is now on China. We're meeting with President Xi, and unless there's some kind of sort of joint Chinese-American pressure happening behind the scenes on Iran for a speedy resolution, oil seems to be, I mean, it's not at its highest levels in the 110, 115 range, but on the WTI here, you can see that it's certainly comfortably over $100, and it doesn't look as though at this point it wants to come down even in, into the 80s or the 70s anytime soon. Just from a technical perspective here, again, I'm not saying this is definitely going to be happening, but just interesting to see from a Fibonacci extension. We had a pretty deep pullback, but if we actually look where this could go, hold on, my computer's a bit sticky this morning with the internet. I think that's about right. You can see here the first Fibonacci extension here does measure out to that recent high at about $110. So absent any sort of resolution in the Mideast, we could see oil. There's no reason why it can't sort of pop up another sort of $6-8 or so. I'm not saying it will do that, but that's the technical sort of perspective there. And so that's and of course Brent also sort of the similar kind of situation. And just in terms of the consumer, look at gasoline here. Gasoline much stronger in a certain sense than even crude oil. And you see that refined products, the jet oil, we've spoken about the diesel, and just the RBOB contract, the gasoline also pushing towards high. So these are all short-term sort of inflationary sort of inputs, which of course are pressuring the yields higher. Now, talking about inflation, we obviously had the CPI yesterday. It will be interesting to get the PPI. We have this PPI coming out in just under about 2 hours. It's about 6:50 as I'm doing this. So it's going to be interesting to see if the input prices into sort of industrial processes and all sort of assets of facets of the economy, if the PPI producer price index also echoes what we saw yesterday, which is expected to be a little bit hot. And just keep in mind that we had the PPI from China last Sunday, which was showing quite a lot of inflation. So globally, we're getting these inflation pressures, and that would argue for sort of yields to remain relatively elevated. So with the elevated yields and still the geopolitical pressure, we are still seeing the US dollar doing relatively well here. It's difficult for the US dollar, I think, to be really massively sold at the moment, just because we have a few political issues domestically in the UK, but we have relatively strong data coming out from the US. We also have strong CPI, and as we've just seen, we have the Fed is now pricing in a few basis points of hikes by the end of this year. Looks as though it's sort of stalled out here between the sort of the 50 and the 100-day exponential moving average here. But overall, the US dollar pretty strong. We see the euro under a bit of pressure. Again, that finding support at the 50-day moving average. The pound down under a little bit of pressure. And that's just because, just getting onto the UK, political situation, we know that quite a few ministers have resigned. Quite a few MPs have also sort of written letters essentially saying that it's time for the Prime Minister Starmer to go. Today we have King Charles delivering the King's speech. That's the opening of Parliament, which is going to present Labour's policy. So the idea here is that there won't be sort of a leadership sort of challenge today, because that would take away from the King's speech. But the rumors going around is that Wes Streeting, who is currently the health minister, may launch a challenge on Starmer yesterday. And the problem with that, why do we care about it? As I was mentioning yesterday, why do we care about that is because the idea is that the potential new Labour leadership wants to go a lot more to the left wing. It wants less fiscal sort of tightness and responsibility, basically more public spending, more public issuance, more issuance of bonds. And therefore, that's putting a lot of pressure on the UK gilts. So the gilts going down in price, higher in yields, and that's pressuring just the overall perception of the British pound here as a government which is less fiscally responsible. So the point is here is that the pound is under pressure. I want to also look at that on the cross pairs, let's say compared to the Swiss franc and the euro. And if indeed we do get a sort of any sense of a leadership challenge, and that Keith Starmer may be out and someone more left wing who wants more profligate spending, I do expect the pound, maybe not so much even against the US dollar, but to maybe fall against the Swiss franc and the or the euro. That's something interesting to be looking at. It's just the pound on some of those cross pairs. We also see US dollar strength against the Japanese yen. No real talk, as I said yesterday, about intervention, although we had, I think it was Kuroda on the wires this morning, essentially saying that if the energy shock continues and the inflation, it may be appropriate for the Bank of Japan to be hiking, but no real feedback there. So the US dollar continues to be pretty strong. In terms of other markets, as I say, let's just get back to the equities here. So we're seeing the ES doing pretty well here. And we know that Trump has taken a lot of CEOs, including the CEO. We've got Elon Musk there. We've got Jensen Huang of NVIDIA. We've got Tim Cook of Apple, obviously. We've got people from Cargill, the agricultural behemoth. We have Citibank, Blackstone, BlackRock. We have all of these CEOs rolling into town with Trump. So the idea here is that there is a strong possibility of sort of several deals being announced. Now, whether they're sort of deals which have already in the pipeline or it's purely cosmetic, purely political theater, the reality is that Trump, I think, will probably want out of this meeting some kind of sense of sort of, agricultural products being bought, soybeans, and sort of deals being signed. So the general vibe could be one of less trade tensions, less tariffs on China, and more trade deals. So generally positive, and maybe that's one of the reasons why the stock market is doing pretty well. And it's just interesting, just looking at the stock market, if we look at just the price action over the last sort of 24 hours, you can see what's going on here. And basically, after the CPI was released yesterday, we had a pretty nasty sell-off. You can see that the CPI came out, where are we? About here or so. And we had a pretty nasty sell-off. It went down to a sort of level, it sold off about 1%. But pretty soon after sort of a triple bottom bounce or retest, we've been nothing but up since. So interesting price action here is that the market is, to me, is signaling to say, hey, we are concerned. We're looking at the inflation situation, but at the moment, the market, believe that the inflation situation will be resolved positively or negatively in a softer way at some point, and that the situation in Iran will calm down, energy prices will calm down, food prices will come down, and that sort of fertilizer prices will come down, and the situation will calm down in general. So the market seems to be more focused, as I say, on the positivity of the AI productivity boost or the infrastructure spending, and potential sort of more sort of deals, so to speak, done with the Chinese. So that's the situation at the moment. And as we say, technically, as we can see, if you look at the measured move here, there's still plenty of upside, at least for ES. Nasdaq is a little more overextended, but positivity at the moment showing in the equities. One area which is also doing pretty well. Just want to look at some of the metals here. So if we look at the metals, not so much gold. Interesting here, the gold remains range bound. But if we start to look over at some of the industrial metals, I just want to show a few charts here. So if we look at DBB, which is the ETF for the base metals or industrial metals, you can see that that's at highs, really exploding very high. And it's not only copper. Everyone's been talking about copper, but if we look at here, you can see aluminium at highs. You can see nickel. You can see nickel doing very well. You can see zinc at highs. You can also see steel doing very well. This is the steel ETF SLX also at highs. And of course, copper breaking out as well. So you can see that, everything doing very well in the base metals. We can also see silver doing very, very well. Just look at the silver on the spot price here. So you can see that silver silver ripping high and breaking out to new highs. Could be a little bit of resistance at about the $90 mark, but basically silver doing very, very well, and copper, as I say, doing very, very well, and outperforming gold. And you have to say that some of that was a technical breakout. But in terms of silver and copper, there's general positivity about the sort of the AI build out and electrification. And in terms of copper, I was reading, I won't go into the details, but reading a research report yesterday that one of the problems with the Strait of Hormuz being blocked is that sulfuric acid, which is required to actually process the copper and refine the copper, a lot of that comes out of sort of that Middle East area, and that's not getting through. That's being blocked. So there's actually less ability to refine copper. So that's one of the technical reasons. There are other reasons, which, as I say, I won't go into the details, but this is one of the supply chain sort of constraints, which is causing some problems in the copper sort of supply chain and the refining process. And that's one of the reasons as well that copper is pushing higher. We also have some of the copper mines with less production happening at the moment, and just that general positivity in the sort of industrial space. So and inventories of forcing down. So there's no reason why copper. Let's just have a look at the technical chart here. I'll go back to the futures. So I'll look here at the high grade. So the US benchmark. It is interesting because we did reach. You see here pretty key level here at 6.69. It could have a little bit of a pause here. Or it could rip high, but basically, just from a technical perspective, let's just finish off with a quick technical look at this. So if we do a Fibonacci extension, you can see here that, sorry, my computer's a bit sticky here. You can see that we did get to the top of that sort of range here. So it wouldn't surprise me if copper has a little bit of a pullback here. And you say, well, okay, where could the bulls come in? Let's look at a bit of a pullback. And I'll put that on, I mean, there's two ways, but let's say we'll do a slightly longer term one here. Just look at the pullback zones. And you're looking at the pullback zones from, let's say, the most recent up impulse on the 4th of May. You can see that a pullback zone, a good buying zone would be something like 6.36 here, which would be the 38% fib retracement, or even just maybe not such a fib sort of level, but just this sort of level here at 6.5 is quite a good level as well. So let's see if copper pulls back a little bit and takes silver down with it. But basically, that's pretty positive. So as I say, just getting back to today, just to finish up, we have the PPI. That's obviously if there's any headlines coming out of the Xi President Trump meeting in China, that's going to be important. And any deals, anything around semiconductors, NVIDIA chips is going to be important because, as I said, Jensen Huang's there. And we'll be keeping an eye also out on the UK for a potential challenge to Prime Minister Starmer. And finally, just in terms of oil, we do get the monthly reports from OPEC and also the IEA coming out today. Be interesting to get their perspective on just the state of oil supplies and inventories around the globe. Okay, guys, that's enough for me for this morning. Have a great day, and I'll be back tomorrow with the macro snapshot. Take care and have a great day. Thank you.